Picture this. You walk into a dealership, you fall in love with a bike, you sign the finance paperwork, and 18 months later, the brand that built it doesn't exist anymore. No warranty. No parts. No dealer to call. Sound dramatic? Mate, it's already happening, right here, in Australia. Over the last 18 months, the motorcycle industry has been hit with one gut punch after another. A century-old Australian dealer empire has gone into administration. A European superbike icon just watched its sales collapse by more than 50% in a single year. An electric motorcycle darling filed for bankruptcy, came back from the dead, and is still fighting for survival. And the biggest name in the business, the one with the bar and shield on the tank, just posted numbers that would make any accountant break out in a cold sweat. So today we are doing something different. We are going through 8 motorcycle brands that are either in genuine financial strife, have already gone under, or are so unstable right now that buying one new could be a serious gamble for your wallet. Some of these are household names. Some you might never have heard of. But if you're an Australian rider thinking about signing on the dotted line this year, you need to hear this before you do. Now look, I want to be upfront about something, because accuracy matters more to me than clickbait. Not every brand on this list is technically bankrupt right now. Some have been rescued, some have restructured, and 1 or 2 are clawing their way back. But every single one of them has been through insolvency, administration, or a financial crisis so severe that it should absolutely factor into your buying decision. I'll give you the real story on each one, not just the scary headline. Let's get into it. 1. Peter Stevens Motorcycles, the collapse that shook Australian riding. We have to start here, because this one isn't some overseas headline. This happened in our own backyard, and it's arguably the biggest shake-up Australian motorcycling has seen in decades. Peter Stevens Motorcycles was founded back in 1970 by 3 brothers, Vince, Steve, and Peter Kyoto, and over more than 50 years it grew into an absolute giant of the Aussie powersport scene. We are talking 15 dealership locations spread across Victoria, New South Wales, South Australia, and Western Australia. At its peak, this one retail group represented 8 of the top 12 motorcycle brands sold in this country, including Harley-Davidson, Triumph, Ducati, Yamaha, Kawasaki, Honda, Suzuki, Aprilia, Moto Guzzi, Can-Am, Vespa, and Sea-Doo. If you bought a bike in Australia in the last few decades, there's a very good chance it rolled out of a Peter Stevens showroom. Then in May 2025, the news broke. Peter Stevens Motorcycles' retail arm entered voluntary administration, putting around 400 jobs on the line. The business was reportedly turning over close to 250 million Australian dollars a year and shifting roughly 8,000 units annually. Numbers that sound healthy on the surface. But underneath, the debt position told a very different story. When the administrators, from restructuring firm Cordamenta, lodged their documents with the Australian Securities and Investments Commission, the full picture came out, and it wasn't pretty. Total debts were reported at more than 65 million Australian dollars. The company owed the Australian Taxation Office around $4.5 million in deferred tax, plus over $300,000 in outstanding GST. Westpac was sitting there as a secured creditor owed $7.6 million. On top of that, there was $26.5 million tied up in retail floorplan financing. That's the loan facility dealers used to actually stock the bikes on their showroom floor, and another $15 million in lease obligations across all those properties. Now, here's a curiosity for you. Floorplan financing is the quiet killer of dealership networks everywhere, not just here. It's how a dealer pays for the stock sitting on the floor before it's sold. When interest rates climb and consumers slow down their spending, that financing cost balloons, and dealers can get squeezed from both ends, rising costs to hold stock, and slower sales to move it. It's exactly the same mechanism that's been hammering powersports dealers in the United States too, and we'll touch on that later in the video. What makes the Peter Stevens story so significant for Australian riders specifically is the ripple effect. This wasn't a single small-town dealer closing its doors. This was a network representing a massive slice of the new bike market in this country. When a distribution giant like that stumbles, it exposes just how fragile the retail side of the industry has become, even when the brands themselves are perfectly healthy. Triumph, Ducati, and Harley-Davidson didn't go bankrupt, but their biggest Australian retail partner did, and that left customers stranded mid-service, mid-warranty claim, and mid-finance agreement. The administrators have said they're exploring buyer interest and believe the business has long-term value, so this story is genuinely still unfolding. But the lesson for Aussie riders is crucial. Even bulletproof, Decades-old brand names can be affected by financial trouble 2 or 3 steps removed from the manufacturer itself. Always ask your dealer some hard questions before you commit to a big purchase. How long have they been trading? Who owns the franchise? And what happens to your servicing if that dealer disappears tomorrow? 2. Harley-Davidson, the icon under pressure. Let's talk about the big one. Harley-Davidson, the most recognizable motorcycle brand on the planet, and right now, one of the most financially troubled. Here's the scale of what's happened. In the 2024 financial year, Harley posted a 15% revenue decline. That was just the opening act. Through 2025, global retail sales fell 21%, motorcycle shipments dropped a brutal 33%, and in one particularly grim quarter, revenue sank to around $1.3 billion, roughly 2 billion Australian dollars, down 23% year on year. North American sales alone fell 24% in that same period. And it wasn't just the sales numbers. There was full-blown boardroom chaos. Board member Jared Doudeville, representing major shareholder H Partners, resigned and launched a public campaign, literally called Free the Eagle, accusing the board of cultural decline and demanding the removal of CEO Jochen Seitz. Seitz announced his retirement not long after. The company went searching for new leadership and eventually landed on Artie Starrs, a guy whose CV includes running Topgolf and, before that, being global CEO of Pizza Hut. Make of that what you will. Then came the fourth quarter results for 2025, released in February 2026, and they were rough. Harley posted an adjusted loss of $2.44 per share, more than double what Wall Street analysts had expected. Consolidated revenue was down 28% for the quarter. To shore things up, Harley-Davidson Financial Services, the company's lending arm, closed a strategic partnership with private equity giants KKR and PIMCO, essentially selling down a chunk of its own finance business to free up cash and pull its debt load back under control. That transaction alone kicked $1 billion back to the parent company in the final quarter of 2025. Now here's where it gets genuinely interesting. And this matters for you if you're watching from Australia specifically. In the first quarter of 2026, Harley's worldwide retail sales actually went up 8.1% compared with the same quarter the year before. Sounds like good news, right? Except when you break it down by region, sales in North America jumped nearly 14%, but sales in the Asia-Pacific region, which includes us, fell over 9%. Europe was down as well. So while the American heartland is showing tentative signs of stabilizing, the Asia-Pacific market, Australia included, is still going backwards. New CEO Artie Starrs has been upfront that 2025 was, in his words, a challenging year, and the company is taking deliberate actions to stabilize the business, restore dealer confidence, and align wholesale activity with retail demand. Translation: they've been overproducing bikes relative to what dealers can actually sell, which forces heavy discounting and squeezes profit margins even further, and they're now trying to correct course. To be crystal clear, Harley-Davidson is not filing for bankruptcy tomorrow. This is a company with over a century of history, a globally recognized brand, and a huge factory and dealer footprint. But S&P has downgraded Harley's credit rating to junk status, which tells you exactly how the financial markets are reading the risk here. If you're looking at a new Harley in an Australian showroom this year, the bike itself is as good as it's ever been, but the company behind it is navigating one of the roughest periods in its history, and that's worth knowing before you sign. 3. KTM, Husqvarna and GasGas, the peer mobility meltdown. If Harley-Davidson's troubles are a slow-motion car crash, what happened at KTM was an outright explosion, and because KTM's parent company, Peer Mobility, also owns Husqvarna and GasGas, this crisis took out 3 motorcycle brands at once. Let's rewind. Stefan Pierer acquired KTM back in 1992 when it was struggling, and over the following 3 decades built it into the largest motorcycle manufacturer in Europe. In 2023, despite hitting a record production figure of over 381,000 motorcycles, the company was bleeding cash, largely thanks to a failed expansion into the bicycle market, which alone accounted for roughly 658 million Australian dollars in losses. Add in supply chain chaos from the war in Ukraine, plus inflation and rising interest rates hammering an already overextended balance sheet, and you had a company in serious trouble. By late 2024, it all came to a head. KTM AG entered self-administration in Austria, essentially the Austrian equivalent of Chapter 11 bankruptcy protection, to try and avoid full liquidation. Hundreds of staff were laid off, with more redundancies flagged, and workers were warned they might not get paid over the Christmas period. Production was halted entirely in January and February of that year. The numbers involved were staggering. Creditors were owed a combined total of roughly 3.3 billion Australian dollars. In December 2024, a packed courtroom in the small Austrian town of Ried im Kreis hosted the creditors' meeting that would decide KTM's fate. After a marathon session that stretched from 9 in the morning until 2 in the afternoon, creditors voted to approve a restructuring plan rather than push the company into full bankruptcy and asset liquidation. It was, quite literally, a photo finish for one of Europe's biggest motorcycle manufacturers. The fallout didn't stop at KTM's own factory gates. As part of the crisis, Pira's 50.1% majority stake in Italian superbike maker MV Agusta had to be sold off. We'll come back to MV Agusta in a moment, because that's its own dramatic story. Meanwhile, GasGas and Husqvarna, KTM's sibling brands, vanished entirely from the Moto2 and Moto3 racing grids for the 2025 season as part of the cost-cutting. The Tech 3 MotoGP team, which had raced under the GasGas banner, was rebranded back to KTM. Fresh capital eventually arrived from investors including Bajaj Auto in India and Chinese manufacturer CF Moto, and by February 2025 KTM's restructuring had received the critical boost it needed to keep the lights on. Production resumed. But make no mistake, this was about as close to total collapse as a major global motorcycle manufacturer has come in recent memory. For Australian buyers, here's what actually matters. KTM, Husqvarna, and GasGas motorcycles are still being sold here, dealer networks are still operating, and the immediate production crisis is technically past. But a company that came within one creditor's vote of full liquidation, and had to sell off one of its most prized assets to survive, is not a company you can assume is on completely solid ground. Parts availability, warranty backing, and long-term resale value can all be affected when a manufacturer's finances are this shaky, even after a successful restructure. 4. MV Agusta, the Italian icon that keeps falling and getting back up. Speaking of MV Agusta, if there's one brand on this list that embodies the phrase chronic financial patient, it's this one. MV Agusta is one of the most beautiful, most storied names in Italian motorcycling. Gorgeous super velocis, screaming triples and fours, decades of racing pedigree. But commercially, it's been a financial rollercoaster for the better part of 3 decades, changing owners more times than most riders change their oil. When KTM's parent company Pira Mobility took a majority stake in MV Agusta back in 2022, it looked like a lifeline. But when KTM itself imploded in late 2024, MV Agusta got dragged straight into the wreckage. Reports at the time suggested around 2,000 MV Agusta units were sitting unsold in a warehouse in Austria, and there was genuine market panic about what would happen to the brand. In January 2025, Pira sold its 50.1% stake back to Art of Mobility, a company controlled by the Sadarov family, who had owned and stabilized MV Agusta in the past. MV Agusta's own statements after the sale were optimistic. Talk of new regional offices, expansion plans, even a potential future entry into MotoGP with a target of selling over 10,000 motorcycles a year. Ambitious stuff. But here's what the actual sales data tells us. In 2024, MV Agusta's global registrations climbed to 4,494 units, a big jump on paper, but a significant chunk of that was down to dealers self-registering unsold stock just to clear the books, meaning plenty of those sold bikes were actually still sitting in European showrooms. Then 2025 hit, and it hit hard. Global registrations collapsed to just 2,148 units, a fall of 52.8% in a single year. That's not a dip. That's a company that's been through repeated restructurings still fundamentally struggling to sell motorcycles at scale. Analysts covering the brand describe a pattern that's repeated for 3 decades. Big talk on brand positioning and marketing, but weak execution on the actual business of selling bikes and generating sustainable profit. To be fair to MV Agusta, they're not hiding from this. The brand has openly acknowledged that recent years have been shaped by continuous struggle despite multiple ownership changes. And commercially, they're still producing beautiful, competitive machines. The Brutale, the Dragster, the Turismo Veloce, all genuinely excellent motorcycles in their segment. The bikes were never really the problem. It's the business behind them that's the worry. If you're an Australian rider drawn to that gorgeous red and silver paint scheme and the sound of an MV Agusta triple, understand this. You're buying into a brand with an extraordinary and genuinely troubled financial history, currently under yet another new ownership structure trying to prove it can finally get commercial execution right. It might work this time. It's worth going in with your eyes open either way. 5. Zero motorcycles, gone from Australian showrooms. Now we come to a brand that isn't just financially wobbly, It's actually exited the Australian market entirely, and this one is a genuinely important cautionary tale for anyone considering an electric motorcycle right now. Zero Motorcycles relaunched in Australia back in 2023, distributed locally by none other than Peter Stevens Motorcycles. Yes, the same dealer group we talked about at the start of this video. Zero had built a decent reputation overseas as one of the pioneers of the electric motorcycle category, with a lineup ranging from urban commuters to genuinely quick supermoto-style machines. But according to Australian motorcycle media, Zero struggled to break through in what's been described as an EV-resistant Australian motorcycle market. Riders cited two big deterrents: price and range anxiety. Electric motorcycles in this country have always faced an uphill battle against a rider culture that loves long-distance touring, remote roads, and bikes that don't need to be plugged in every 150 kilometers. Then, when Peter Stevens Motorcycles' retail arm broke apart during its own administration process, Zero Motorcycles Australia's position became untenable. The result? A liquidation sale. Approximately 420 Zero electric motorcycles were offered up across 4 separate auctions run by Pickles, with lots located in Victoria, New South Wales, the ACT, South Australia, Western Australia, and Queensland, sold at heavily discounted prices to clear the stock entirely. That's effectively the end of Zero as an available new bike brand in this country, at least for now. Here's a genuinely useful curiosity for anyone thinking about buying second-hand. If you spot a used Zero motorcycle for sale in Australia at what looks like a bargain price, understand exactly why that bargain exists. There's currently no official local distributor, which means warranty support, part supply, and servicing knowledge could all become genuinely difficult to access. That doesn't necessarily mean don't buy one, but it absolutely means go in with your eyes open about long-term ownership costs. This story also says something bigger about the broader electric motorcycle market globally right now. As we're about to see with our next 2 entries, Zero isn't the only electric motorcycle brand that's hit serious financial trouble in the past couple of years. There's a pattern forming here, and it's worth understanding before you get swept up in the hype around going electric on 2 wheels. 6. Cake, the Swedish startup that died and came back. If you haven't heard of Cake, that's understandable. They never had an official presence here in Australia. But their story is one of the most dramatic in the entire electric motorcycle world, and it's a brilliant example of exactly how fast a hyped startup can implode. Cake was a Swedish company founded in the mid-2010s, known for slick, minimalist, almost toy-like electric motorcycles, models like the Corka Froda, the Osa utility bike, and the Macca urban commuter. They generated an enormous amount of buzz for a company their size. There was a marketing campaign called the Electric Conquest of Continents, where professional riders crossed Africa and North America on Cake bikes. They partnered with Goal Zero to build stealthy bush bikes to help African wildlife rangers fight poaching. It was genuinely cool stuff, and the design won awards. But underneath the slick marketing, the business fundamentals were shaky. Cake had raised over $74 million US, call it roughly 115 million Australian dollars, in funding over the years, but had only ever sold around 6,000 motorcycles since the company's founding. By the company's own admission, they wouldn't be cash flow positive until they were selling between 7,500 and 10,000 vehicles annually. They never got close. Then in January 2024, a lead investor pulled out just before a critical funding round was due to close. Employees had their salaries delayed. And on the 1st of February 2024, Cake's board filed for bankruptcy in Sweden. CEO Stefan Idderborn was candid about it publicly, saying, and I'm paraphrasing his comments to Swedish media here, that it wasn't one single cause but a combination of factors. The broader climate tech investment cycle had turned, the venture capital ecosystem for hardware startups had gone cold, and Cake simply couldn't secure the bridging finance it needed. Here's the twist, though. Cake didn't just disappear. Later in 2024, new ownership based in Norway acquired the company's remaining assets through the Swedish bankruptcy administration process, and Cake reopened its original Stockholm headquarters and brand store. Former team members, including the company's chief technology officer, came back on board. As of the most recent updates, Cake is technically alive again, but as a much smaller, more cautious operation than the globally expanding startup it once tried to be. The lesson here for Australian riders, even though Cake never officially sold here, is about the electric motorcycle startup category more broadly. Slick design and great marketing can absolutely mask a business that's burning cash faster than it can bring it in. If an EV motorcycle brand looks incredibly cool but is relatively new, privately funded, and doesn't have a long trading history, do your homework on the company itself, not just the bike. 7. Energica, Italy's fastest electric motorcycle, with the shakiest finances. Energica is a genuinely important name in the electric motorcycle world, because for years they built some of the most powerful, longest-range electric motorcycles on the planet, fast enough that they were the exclusive supplier for Moto E, the electric class that used to support MotoGP race weekends. Founded in Modena, Italy in 2014, Energica built a strong reputation among moto journalists for machines like the Ego Superbike and the Xperia Adventura. In 2022, American company Ideanomics completed a takeover, injecting fresh capital that helped Energica scale up production and expand its dealer network internationally. For a while, it looked like the financial backing Energica had always lacked had finally arrived. Then Ideanomics itself ran into serious financial trouble. The American parent company was hit by fraud allegations and its own cash crisis, and the investment flowing into Energica dried up completely. Energica's workforce had already been cut from 149 employees down to 50 as part of a cost-cutting plan, but it wasn't enough. In October 2024, Energica's board resolved to enter judicial liquidation, essentially an Italian bankruptcy proceeding, after months of what the company itself described as serious economic and financial crisis. Employees had been on Italy's version of a government wage support scheme just to keep getting paid, and were reportedly close to striking before the liquidation filing came through. For 9 months, Energica's future was genuinely uncertain. But then, in July 2025, a lifeline arrived. A group of investors based in Singapore stepped in with a serious offer and a significant deposit to take over the business through the judicial sale process. By September 2025, the deal had completed, and Energica confirmed it was beginning the long climb back to full production, starting with restocking parts so existing customers could keep their motorcycles on the road. Here's a fascinating bit of context for why this keeps happening across the electric motorcycle space. In 2023, Energica's biggest global rival, Zero Motorcycles, sold only 383 motorcycles worldwide, a genuinely tiny slice of the overall market. The entire premium electric motorcycle segment has simply not grown anywhere near as fast as the venture capital and corporate investment poured into it expected. High price tags, limited range compared with petrol bikes, and a slow-to-convert enthusiast market have left several of these companies structurally underfunded relative to their ambitions. Energica motorcycles have never had an official, ongoing presence in mainstream Australian dealerships, so this is less of a direct don't buy new warning for local riders and more of an important data point. Together with Zero and Cake, Energica completes a pattern of 3 separate premium electric motorcycle brands that have all gone through insolvency or bankruptcy within roughly the same 2-year window. If you're excited about the electric motorcycle future, and there's plenty to be excited about, just understand that the businesses behind these bikes are still working out how to survive commercially, even when the technology itself is impressive. 8. LiveWire, Harley's electric spin-off, still bleeding cash. Our final entry brings us full circle back to Harley-Davidson, because LiveWire is Harley's own electric motorcycle brand, spun off into a separate, publicly traded company back in September 2022. LiveWire's pitch was straightforward: take Harley-Davidson's brand power and manufacturing know-how, and use it to build a genuinely credible American electric motorcycle. The company also owns STACYC, which makes electric balance bikes for kids and has become a surprisingly solid earner in its own right. On the New York Stock Exchange, LiveWire trades under the ticker LVWR. The financial reality, though, has been rough for years. For the full 2025 financial year, LiveWire posted a consolidated net loss of $75.1 million, call it roughly 116 million Australian dollars, although that was actually an improvement on the $93.9 million loss the year before. Full year 2025 revenue came in at just $25.7 million, which was actually down 4% compared with 2024, even though unit sales were up 16%. In plain English, they sold more bikes but made less money doing it, largely thanks to incentives and discounting needed to move stock. There have been some genuinely positive signs more recently. In the first quarter of 2026, LiveWire reported an 86% jump in revenue over the same period the year before, electric motorcycle unit sales up a huge 176%, and the company maintained a 76% market share of the US electric motorcycle segment above 50 kilowatts. CEO Karim Donnez has talked up the upcoming launch of a new model called the S4 Honcho, targeted for spring 2026 production. But here's the number that matters most. Even with all that improvement, LiveWire is still losing over $18 million a quarter. This is a company that's been burning cash since its very first day as a standalone business, is still years away from profitability by most analyst estimates, and exists entirely within the electric motorcycle category we've already established is struggling globally to find its commercial footing. LiveWire motorcycles have had a limited and inconsistent international footprint, with the brand's focus overwhelmingly on the North American market. For Australian riders, that's arguably the most important takeaway of all. A genuinely troubled electric motorcycle brand, backed by one of the biggest names in the industry, still can't reliably turn a profit even in its home market, let alone commit to long-term support in markets further afield like ours. What this all means for Australian riders. So, stepping back, what's the actual pattern across these 8 stories? 3 of these brands are electric motorcycle makers that have each gone through insolvency in the space of about 2 years. Zero's local distribution collapsing, Cake going fully bankrupt then reviving under new ownership, and Energica doing the same in Italy. That tells us the electric motorcycle category, however exciting the technology is still financially immature as an industry. 2 of these stories, KTM's near collapse and MV Agusta's repeated crises, are tangled together through the same parent company, Pira Mobility, and show how fast contagion can spread when one brand in a corporate family gets into trouble. Harley-Davidson and LiveWire show that even the biggest, most recognizable names in the business aren't immune from serious financial pressure, one from declining global sales and boardroom turmoil, the other from years of sustained losses in a genuinely difficult new market segment. And Peter Stevens Motorcycles reminds us that even when a manufacturer's finances are perfectly healthy, the dealer network standing between you and your new bike can collapse entirely, leaving Australian customers exposed regardless of which brand badge is on the tank. None of this means don't ride, and it definitely doesn't mean these companies are all doomed. Several have already staged genuine recoveries. But if you're about to drop tens of thousands of dollars on a new motorcycle here in Australia, do a bit of homework first. Check how long the dealer's actually been trading. Ask about the manufacturer's local parts and service commitment. And if you're drawn to an electric motorcycle in particular, understand that this is still a genuinely young and financially volatile corner of the industry. Right, that's the list. 8 brands, 8 very different stories, and 1 big lesson. The badge on the tank doesn't always tell you the whole story about what's happening behind the scenes. If this video helped you out, do me a favor and smash that like button. It genuinely helps get this kind of information in front of more Aussie riders who need to see it. Subscribe if you want more deep dives like this one, because there's plenty more where this came from. And I want to hear from you down in the comments. Which of these 8 surprised you the most? Were you already across the Harley-Davidson numbers? Or did the MV Agusta collapse catch you off guard? Let me know below. Stay safe out there, ride smart, and I'll catch you in the next one.